gold is already being price discovered in the Eastern physically backed markets. The formalizing of the financial infrastructures to support liquid global settlement is the final piece of the puzzle, and it will be the death knell of the Comex if it does not become Basel III compliant. Talked about it before. Yeah, you can avoid being Basel III compliant. You can keep playing your paper game, but you've got less and less people to actually cover your exposure into. You're in trouble. Simply, what happens is you're going to influence the fixed price through your Comex gaming, and that's going to be delivered. And then they're going to turn around on you. And what they're doing in silver right now is loading up at the back door and taking it and literally draining those vaults.
As of June 2025, the gold market enters a decisive corrective phase after reaching historic highs earlier this year. Since mid-April, gold prices have declined by roughly 11%, marking one of the most notable retracements since the start of the current bull cycle. The pullback ripples through the broader precious metals sector, impacting silver, platinum, and mining equities alike. Yet, this decline does not unfold in response to weakening fundamentals. Inflation remains elevated across advanced economies, fiscal deficits expand globally, and monetary policies continue to signal long-term instability. Central banks persist in reallocating reserves away from fiat-denominated instruments and into physical gold. Andrew Maguire, a widely regarded authority in the bullion markets, draws attention to a growing divergence between futures-based price signals and the strength of physical demand. He explains that the current softness stems primarily from derivative positioning, with price movements on exchanges like Comex reflecting speculative unwinds rather than a collapse in real demand. At the same time, central banks, particularly in Asia and the Middle East, continue acquiring gold at a steady pace, underscoring their strategic view of gold as a reserve anchor. Maguire also highlights increased interest from family offices and institutional wealth across emerging markets. He warns that as more metal leaves the open market and enters permanent holdings, liquidity in the physical market continues to tighten. According to Maguire, the longer this imbalance persists, the more vulnerable paper pricing structures become to systemic repricing, one that could be triggered by a breakdown in confidence or a shortfall in deliverable metal. Looking ahead, Maguire views the current phase not as a weakness, but as an early signal of a major structural transition. With synthetic gold markets increasingly misaligned with physical reality, the case for a valuation reset grows stronger. He identifies the $4,000 per ounce level as a realistic and data-driven target, supported by sustained accumulation, geopolitical hedging behavior, and the erosion of credibility in paper benchmarks. If the gold market shifts toward physical settlement and away from derivative dominance, it could reassert its historical role, not merely as a hedge against uncertainty, but as a cornerstone of monetary confidence in a rapidly evolving global order. Now, we present the clips from Andrew's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
This is about education. It's really about taking questions, the best questions, or the most appropriate questions. They're all good questions, but the most appropriate question for what's happening right now. And actually, this question from Doug is great because it covers really a full spectrum of questions, and then we're trying to make this interesting for everybody. And obviously we have everyone from institutional traders all the way through to brand new stackers and investors looking to understand really what is driving the often mystifying gold price setting process and who the current main actors are. So even an institutional who would know all that wants to know who's behind it, et cetera, et cetera. So hopefully this is, and we'll drill down so to provide a little context for those that don't know a lot of this stuff. Look, to provide better context for this wider range of subscribers, I'm going to answer Doug's question by walking through the most recent example of the current gold sell-off, which we have just seen, and who was behind it, and what was the objective. Now, Doug's question mirrored a lot of questions, and while this kind of deliberately created air pocket comes as no surprise to many subscribers, long-time subscribers, There are many other people rightly puzzling as to why gold suddenly reversed $150 per ounce from last week's tag of 34.50. Now, it's a good time to kind of quickly hop in on the charts to best illustrate just how counterintuitive the selling actually was, especially as we have very strong physical demand drivers powered by a race by central banks and sovereigns to sell dollars for gold into a series of higher stair steps. I'm going to show some links for that in a little while. But here, let's have a look at the charts. So this leads us to identify who really led the sudden gold sell-off, why they were behind it. And despite their best efforts, all it's done is to discover the next of a series of fresh, physically supported higher stair steps along the way, leading to $4,000 gold and $4,500 gold, but $4,000 being the immediate target. Now, I'm recording this at the pit open on Wednesday, and then Wednesday the 25th, which is also options expiry, and really a good time to sort of check through the footprints leading into it. Just to say though, this is a futures chart, which is trading in sync with spot, except that the futures chart, because it's a further out contract, is actually trading at around about a $13 to $14 premium to spot at this point. And that simply reflects the carry costs into this longer dated contract. So let's start off by looking at the spot 34.50 level, which is currently 34.64 futures. So and that was here, it was higher. So this was pretty much the top of the range. So following very strong SGE, Chinese safe haven physical gold demand at spot 34.50, which had picked up into Friday the 13th, which is pretty much here, just before we opened up on the Monday after. So this was very strong demand and noted on Friday the 13th. And that was obviously to do with heightened war risks and one thing and another. And that followed through with more buying at this SGE Open, Chinese Open on Monday the 15th, for spiking another $20 higher. And then we got a sudden, really essentially the start of a $150 waterfall into the 3,300 level. Now, again, there's about a $12, as you move down, about a $12 premium to futures. So this line represented 3,300 spot. So this picked up steam rapidly, and really at a time when gold really should be doing what it was saying on the box, namely acting as a safe haven. And the selling was extremely counterintuitive. And really this was what drew the attention of the first-tier liquidity providers, whose really job it is to ensure Basel III NSFR compliance at the global-facing FX gold fixes, and were having to supply gold into those fixes into this series of lower prices. And for reference, this is obviously before the PM fix, so I've just marked in where the AM fix was this morning. So the reason I'm showing this is really because we want to step through the footprints, as it provides a timely example of how, as Doug puts it, he said, given most people do not own gold, how can it be possible that everyone is selling their gold? And that, we need to answer that question. And this also leads into his questioning about government suppressing the price of gold. So this is a really good question. We're going to drill down into his whole question. Now, the first thing we need to do is differentiate the difference between the tiny percentage of Western-facing funds and people who own or stack real physical gold. There's a big difference. And the physical buyers never sell their gold versus the paper gold traders who place really just high leverage futures bets targeting a higher or a lower cash settled gold price expectation. Now, we call them, obviously, the speculators. Now, these paper or synthetic gold traders are what they're doing is borrowing gold from what is essentially a cartel-rigged casino environment with the house pitched against them. Now, we call it the Comex casino, where you can borrow exposure to paper gold with only really 4% of skin in the game, which makes it very attractive for speculators. Now, that means a speculator can currently control 100 ounces a contract of gold worth $340,000 for a tiny $15,000. Now, the trouble is, leverage works both ways. And in this case, these speculators have been buying gold for the similar reasons as physical buyers do, except for one very big difference. Paper gold can be created out of thin air, while physical gold is limited in supply and is extremely sensitive to supply-demand fundamentals, because physical gold is globally fungible. This is the important part. It's globally fungible. No matter where you go in the world, gold is recognized as money, and it's the same value around the world, whatever that value of that gold is each day.
Many analysts, including Andrew Maguire, are warning that gold and silver are now entering a structurally transformative phase, one in which physical market dynamics are beginning to eclipse the synthetic, paper-driven pricing mechanisms that have dominated for decades. Gold continues to trade near the $3,350 level, while silver remains tightly compressed around the $35.20 mark. These price zones, often influenced by options expiry and managed derivative exposure, are no longer able to fully mask the strain building beneath the surface. Maguire highlights a critical drop in silver's open interest, down by more than 1,500 metric tons within a matter of sessions, suggesting that market participants are quietly exiting paper positions as delivery risk intensifies. Concurrently, the consistent premiums in the physical spot market over futures contracts point to a tightening of supply that cannot be ignored, a sign that real demand is beginning to assert control over a long-manipulated market. This shift is accompanied by a broader migration away from legacy pricing systems such as the Comex and LBMA, as newer exchanges and institutional frameworks begin favoring physical settlement and transparency over unallocated contract structures. Andrew Maguire emphasizes that this quiet revolution in how metals are traded and settled is gaining traction not only among private investors, but also among central banks, especially within the BRICS alliance, who have been accelerating their physical gold accumulation and increasingly repatriating reserves. These developments coincide with a global trend of moving away from dollar-based trade, with gold and silver reclaiming their historic status as monetary anchors. Let's get back to the interview.
All the physical supplies ever put on offer, at any price that is, doesn't matter if it's high or lower, an increasing number of global central banks are seeking to actually now repatriate gold they already own back to their own vaults. Again, Financial Times. Central bank buying and gold repatriation stepped up significantly after physical gold was reclassified as a first-tier NSFR compliant high-quality liquid asset. As also reported here, foreign central banks continue to want their gold back.
All right. Thank you, Andrew, for that amazing question. I think the entire community is going to agree with me when I say that you've just put a bright, shiny light right down the casino cartel rabbit hole. And now, just to cover off on the other questions from the community about what do you expect in the short term here, and what's your take on things that are happening right now?
Sure thing, Shane. Obviously, central bank demand alone is going to underpin a series of higher stair steps. But very short term, while no one will chase anything until all the options or these OCC bets are squared today and the OCC bets on Monday, this is what we're seeing. And obviously, nobody's chasing anything. It's being capped heavily. These are big derivative bets that could take down the too big to fail bullion banks. We're talking about one component of a 2 quadrillion derivative market, and gold is a very big aspect, and silver is a very big aspect of that. Now, the gold futures OPEX structure for today, the sweet spot is 33.50. Go figure, look at the chart. With every strong resistance, with really, really strong resistance at 3,400. So it's not going there before expiry. Hence the price capping. And as is always the case into synthetic Comex-centric options price suppression events, no one will be chasing anything above the option sweet spot. But liquidity providers report these capping shorts are once again stealthily being alchemized, very quietly, coiling gold for a physically driven catch-up rally. Now, liquidity providers are reaffirming the strong Asian safe haven demand is definitely at odds with the usual official gold capping events, which historically, they always follow a geopolitically driven reason to buy gold. You know, every time there's a geopolitical event, gold spikes higher, immediately gets taken back down again. Why? Because it's immediate FX market intervention. They don't want people racing into gold, literally. But once that initial gaming plays out, then gold tends to rise. But by design, the rise won't be attributed to the undiluted race into safe haven physical gold. Of course not. They don't want you to see it. Spot silver demand is also evident into Eastern markets. But as we identified earlier, silver futures were flash sold through targeted long stops to exactly hit its 35.20 options sweet spot, where immediately it evidenced obvious and very large house short covering. Notably, the spot low of the day, was 10 cents higher than the futures price, which should not be happening. And what it illustrates is a mispriced market. And while Citi and all of these and those hangers on haven't publicly tried to talk silver down into the current 35.20 sweet spot, they're also reported to be behind the capping in silver futures. Spot silver is trading at a consistent premium to silver futures. That shouldn't be happening. Currently today it's 6 cents, but it's been as high as 12 cents or $600 per contract. Now, given though through the last 4 sessions, silver open interest has evidenced 9,682 or 1,500 tons rinsed out, even averaging the spot premium to futures at, say, 6 cents, that's close to $3 million of house positions that have been rinsed out by the pit managers. That's the game. This is telegraphing foreign exchange silver is being locked in, though, because the foreign exchange price is higher than the futures price. Because it's being locked in at the FX fixes to future at premiums. And it also indicates the imminently expiring July Comex silver contract, which goes into delivery at the end of June, will be stood for delivery and will be drained of cheap, immediately accessible silver and the current open interest that remains. So the potential delivery exposure right now is a very large 6,000 tons. And while a lot of these positions will, of course, they'll be rolled into the upcoming September contract, there are only 2 sessions left to actually deliver the last 1.4 tons of June deliveries. Why the heck anyone would hang on to the last day to deliver a June delivery that should have actually been delivered at the end of May? So to sum up, basically, and it's being led by Citi, stick handling, official OCC bets. And while we expected a last kick at the can ahead of US Basel III compliance, all it has achieved is to secure the next higher, globally determined, higher price stair step with almost no paper speculators on board to rinse. Just to finish up, though, we have contacts on the ground and we'll be closely monitoring the upcoming 17th BRIC Summit in Rio on the 6th and the 7th of July. And we're going to provide a full update in our last episode that will be recorded on the 9th of July. So BRICS, remember, is a platform for accelerating financial multipolarity with a view to expanding the new development bank so as to bolster national currencies in intra-BRICS trade benchmarked to gold. That's the key thing. And with gold markets now being discovered in Asia, prices now being discovered in Asia, as Bloomberg draws attention to, it provides the BRICS autonomy. Gold is already being price discovered in the Eastern physically backed markets. The formalizing of the financial infrastructures to support liquid global settlement is the final piece of the puzzle, and it will be the death knell of the Comex if it does not become Basel III compliant. We've talked about it before. Yeah, you can avoid being Basel III compliant. You can keep playing your paper game, but you've got less and less people to actually cover your exposure into. So you're in trouble. And simply what happens is you're going to influence the fixed price through your Comex gaming, and that's going to be delivered. And then they're going to turn around on you. And what they're doing in silver right now is loading up at the back door and taking it and literally draining those vaults. So unless it becomes Basel III compliant, goodbye. Now, gold is strengthening the BRICS currencies at the expense of the dollar. In case you haven't seen the ECB financial stability review, drawing attention to the unallocated paper gold to physical imbalance, identifying large foreign counterparty derivative exposures that must be brought back into essentially rising prices. So the only question left to ask our dear subscribers is, how prepared are you to protect your wealth from the next leg of the dollar and related fiat debastements? How much physical gold and silver?
If this shift toward physical settlement and away from synthetic pricing continues, the long-term effect on gold and silver could be seismic. As unallocated paper markets lose credibility and liquidity dries up, the real value of physical bullion, driven by actual demand and constrained supply, may surge dramatically. Gold, once manipulated through futures contracts, could break free into price levels that better reflect global central bank accumulation and currency devaluation trends. Silver, far more volatile and industrially essential, may see amplified moves as its dual role in green energy and monetary protection becomes impossible to ignore. In a scenario where traditional institutions lose grip on pricing control, we could witness a repricing shock that reestablishes both metals not just as hedges, but as foundational pillars in a new, post-dollar financial order. What do you think will happen to gold and silver prices as physical demand overtakes paper trading and the old financial systems lose control? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.